Welcome to Upticks. I'm Jake Falcon.
And I'm Corey Bittner. We're the founders of Falcon Wealth Advisors and your co-host for Upticks.
Today is our 41st episode, Retirement Mistakes to Avoid.
We're talking about retirement mistakes to avoid, dividend-paying stocks, questions worth asking in the Masters.
Okay, Corey, so I named our episode Retirement Mistakes to Avoid because I think as part of this show, it is the most important piece that we're going to go over today. And why don't you kick us off and we'll kind of do what we did last time and we'll give our audience 3 mistakes to avoid. So maybe we'll start off with your number one mistake that you tell your clients when they're looking to prepare for retirement of something that they absolutely make sure that they don't want to mess up.
Making sure that they understand their retirement liquidity. In other words, making sure they understand they know where they're going to be able to pull money from without penalties.
Gotcha. So you want to make sure that if they're 50 years old and they're not 59 and a half, how are they going to fund that monthly income need?
Exactly. Yes, and I should have prefaced that it's important for everyone, but it's particularly important for people retiring before 59 and a half.
Okay, so that's very good. So to elaborate on that, so first and foremost, you want to make sure that you have enough, but what you're getting at is it's one thing to have $1 million, $2, $3, $4, $5 million. It's another thing to know where that income or where your paycheck replacement is going to come from. And you certainly don't want to pay Uncle Sam any tax penalties if you can avoid it. So why don't you just kind of give a high-level overview of what the rules are so that maybe somebody watching this, if they're 50 years old, that they know something that maybe they need to be aware of.
Sure. So if, in your example, if someone's 50 years old, the idea is traditionally an individual retirement account or a 401k is something that it's not really designed for them to necessarily access before 59 and a half, but there's a couple of caveats there. Same way with the Roth IRA. You can always pull your contributions out, but you can't touch the earnings before 59 and a half. And then lastly, if somebody has an after-tax account, obviously like money in a checking or savings that they've saved, or a brokerage account or an after-tax account, that of course is accessible penalty-free.
So what you're saying is if you're 50 years old and all of your money's in your 401k, you're not going to be able to access that money if you put it away pre-tax without potentially paying a penalty.
Yes.
What is the penalty?
It's 10% of any gross distributions that come out in any given year.
Okay.
Now, there are a couple of ways around that,
right?
Which are strategies that we've used, that we've talked with people about before, because, fortunately we have lots of clients and have met with a lot of people that are in the situation where they can afford to retire before 59 and a half. We just have to make sure we can fund their lifestyle. So if someone's retiring before the age of 55, there's something that's called the 72T distribution that we've used before.
Gotcha.
Which is at a very high level. It's basically just a way that somebody can access funds from a pre-tax IRA penalty-free before 59 and a half. And then if someone's 55 or older and they have money that's in their 401k, typically if they retire from their company and they leave money in the 401k plan, they don't roll it out of there elsewhere, they have access to that money penalty-free prior to 59 and a half also.
Gotcha. So that's a lot of information we just went over in a short amount of time. I think ultimately it pays to work with a chartered retirement planning counselor, someone that's obviously aware of all of these rules and tax laws, so they can help you navigate and make a good informed decision. So good. So for our number 2 or my number 1, I would say make sure that when you're filling out paperwork for a potential rollover of your funds, whether that be a pension or your 401k, that you're working with somebody else that's done it before.
Yeah.
Because if you call your 401k company, you say, I'm retiring, I need my money, and you get the wording wrong, they may cash out your account and you may be subject to taxes and penalties where you could have avoided that if you rolled over the funds. So I think a big retirement mistake to avoid is to work with a professional. Again, like I said, Corey and I are chartered retirement planning counselors. You want to work with somebody that's done a lot of rollovers and helped people fill out pension paperwork before, so they can help give you good advice as to which elections to make. Because you can really mess that up, and it could cost you and your family thousands of dollars, really just by filling out a form incorrectly.
Yeah, checking the wrong box can be quite expensive.
Yeah, and it's crazy. And typically, once it's happened, the IRS isn't very lenient. I mean, there's some things you could plead and try to get an exception or get the funds replaced within a tight window, typically 60 days. But again, it's something you don't want to mess with. You certainly don't want to get that wrong if you can avoid it. You got a third one?
I do. I think the third one I would say is make sure that you have an idea of what your lifestyle is that you want to maintain, and make sure that, I mean, it almost sounds simplistic to say make sure you've got enough money, right? But the idea there is, I think more about that specifically, not necessarily just from a budgeting standpoint, but know what your financial plan allows for as far as spending goes.
True.
And make sure that, that you're comfortable with that.
Yeah, why retire if you can't, go out to the movies?
Correct.
Or if you can't go on a trip, you can't go to Branson,
right?
Because you can't afford it. Then why retire?
Yes.
It's tough if, our clients, we don't want them sitting at home on their, lazy boy and watching The Price is Right because they don't have any money. That's not what we're in business to do.
Right.
So definitely, we want to make sure that, capital has a purpose and it's a means to an end. It's to buy goods and services, and we want to make sure that you have the appropriate capital to buy the goods and services that you want to do.
Yes. And the fact of the matter is most people become accustomed to a certain lifestyle and they don't want to have to sacrifice that when they're retired. That's the goal, right?
Right. Like I'm a big golfer. When I retire, I'm not going to stop playing golf.
Right.
Right. Or maybe you like taking your fiance to Capitol Grill, once or twice a month. You're not going to stop doing that when you retire.
Right. Or paying, to be a member somewhere so I can play tennis and do that at my leisure.
Right.
I'm going to want to keep doing that.
I'm sure a guy like you is going to want to go to a lot more St. Louis Cardinals games.
Maybe so, yeah.
And whatever,
Sure.
Whatever subscriptions you have, if you, newspapers or
all that stuff.
Netflix and all that. You
all
don't
adds up, yeah.
Yeah, you're not going to stop doing that.
Correct.
So again, don't kid yourself. Budget for those. Plan for those. We want our clients to have a certainly enjoyable retirement.
Yes.
So again, these are really good. So these are 3 mistakes to avoid. Number 1, make sure you know where your income is coming from.
Yes.
And that you're avoiding any penalties if possible. 2, we want to make sure that if you are transferring money that you're doing that in a correct manner. And again, you're not making any mistakes on any forms. And then 3, know what that budget is or what that lifestyle is going to look like.
Yes.
Because again, I think it's important that you kind of have an idea of what this transition is going to look like going into retirement.
Exactly.
Very good. Okay. So good. Those are good 3 retirement mistakes to avoid. Let's switch gears a little bit and let's talk about our investment topic today. I wanted to give a high overview of why we buy dividend-paying stocks for our clients.
Okay.
So why don't you just kind of define what a dividend-paying stock is? You don't have to give any specifics, but maybe just what does that mean to an investor?
The idea is if someone is buying a dividend-paying stock, it means you would own shares in a company that typically pays a dividend on a quarterly basis, meaning, let's say it's 30 cents per share or whatever. I'm just making up an example. But a company would actually send you a check or your account, a dividend gets paid and it goes to cash in your account, and that happens on a quarterly basis. And that's what the company does to reward its shareholders. So it's a way to generate an income stream based off of their profits and everything else.
Gotcha. So you're not necessarily selling any stock to generate
Correct.
This income. So if you have 100 shares and you get a dividend, you still own the 100 shares.
Yes.
A big misconception, though, is a lot of clients don't know this, is that the stock price, though, will drop the day that the dividend is paid. So if you get a 30-cent dividend, the stock price goes down by 30 cents.
Right.
So it doesn't mean that it's just it's income without any any adjustment. The price is adjusted, but again, for dividend investors, they don't really care about the price movement as much as the income.
Exactly.
And so we believe in dividend stocks for our clients' portfolios, but we don't only buy dividend stocks. We have what are called growth stocks in there as well. So we don't, we want to have both so that we can rebalance between the two. But certainly for our clients that are retired, they do live off of that income as part of the stream of money that they're pulling on a monthly or quarterly basis.
Exactly. And the fact of the matter is the stocks that pay dividends and generate income and the growth companies that don't both belong in a diversified portfolio.
In our opinion, they do, yeah.
Right?
And so the idea, too, is that so you're retired, you own a dividend-paying stock. That dividend is almost like a bond, paying you interest. We send that dividend out to you. Now, if you're not working, if you're not retired, we still think dividends play a role in a portfolio. Now we just take that cash and we'll reinvest it either in another stock or maybe some of the same stock or whatever that may be. But again, that's just more cash accumulating that you can turn around and reinvest if you are still working and you're not retired. Another point I wanted to make is the type of dividend stocks that we buy are typically we look for companies that have a history of increasing their dividend over time. If a stock's paying a 30% dividend this year in 2019, that's great. But, we want to look out 2025, 2035, many years down the line, has this company traditionally increased its dividend for cost of living adjustments, right? The idea is that, inflation happens and we want our clients to get more income from their holdings, not stay the same.
And it's a good point because a dividend's not guaranteed, right? And if a company's trending in the wrong direction, they can cut their dividend.
Yeah, it's a very good point.
And that's another what we're trying to avoid.
Exactly, and that's something that we look at very closely also, that if a company cuts its dividends, typically not a good thing. So we'll typically look to maybe move out of that stock or move in a different direction to try to keep that income level high. If you're in a mutual fund, if you're in an exchange-traded fund, if you're in an annuity, you may or may not be invested in dividend stocks, but the problem is those investment products are taking their fees, which again just lowers the amount that you collect. So again, we don't believe in products for our clients that can afford it. We buy stocks and bonds certainly outright. And if you can't, we'll do the next best thing, which is, in our opinion, an exchange-traded fund. But for our clients, typically most all of them can afford individual stocks. We'll buy the stock, they'll collect the dividend, and again, there's no mutual fund or annuity dipping their hands fee-wise into that return.
Correct.
All right, good. So now to our fun portion here, which is questions worth asking. I wanted to ask you a question first, and then we had actually a client reach out to us with a question that they liked us to address on air here. So the question I want to ask you, I think is a pretty simple one, but sometimes people forget it. Is that, well, maybe not simple, but I have a client that, they're getting close to paying off their car. And they said, you know what, I don't know what the exact conversation was because, one of my assistants took the call, but basically they said, why don't I just pay this car off and pull out the money from my account? What would you say to a client that asked that question to you?
Well, the first thing I would say is probably it depends on whether or not that makes sense, but let's kind of evaluate it from a financial standpoint first.
Right.
And depending upon, what the value of the loan is, how much their account is worth, those are obviously factors. But I think probably the most important ones would be, well, they're all important, but thinking about what is the interest rate on the loan versus what's the interest rate that the investments are making you.
Or the target, right?
Or the target return for that matter. Because the idea there is if the car loan is 4.5%, but their target rate of return is 7%, the idea is if that money is invested and it's earning more than the loan is costing, it might not necessarily make sense, at least from a financial standpoint, to just, sell securities and pay it off.
Good answer. That's what I relayed back to my assistant that took the call. As I said, look, even if we needed to send a little bit more money monthly to make the car payments.
To help out with the cash flow.
Again, and I know there's not car loans more than 6 or 7% right now because I know interest rates are low. Mm-hmm. So again, the interest rates being low, it doesn't really make sense. Again, we're numbers guys. We're always going to tell you what's the mathematical best solution for you, but ultimately it comes down to an emotional decision as well. But my client gets it. You're right. I just want to, I'm just so close. They probably were thinking, hey, do I just pay this thing off? But it's like, look, let's just make the payments. Let's keep your money working for you. Mm-hmm. So in the end, you've got that much more for your fun things, whether that's trips or, upgrading your home or whatever that may be. You've got a little bit more cash flow because you're doing that.
Sure. And I can empathize with that myself because I know what that's like. I've had, since I graduated college, student loans that I've been paying on, right? But now I'm getting much closer to having those paid off. And I've thought about, well, what if I just paid this loan off just to be done with it, right? The same way that anybody would approach something like that. It's like, well, wait a minute. Let's take a look at, what impact that would have versus what the interest rates are. And it makes more sense to just make the monthly payment.
Right. Okay, good. And then
so let
question the client asked? Yeah.
Yes, so I'm going to read it off here. I have it queued up here. So the question was, it's more of a statement and a question. I was just reading an online advertisement from Vanguard about the benefits of a money market account over quote-unquote just stocks and bonds. I thought maybe for one of your podcasts you could do a pro-con compare-contrast of the two different approaches to investing.
Yeah, it's a good question. So Vanguard's out there probably advertising, I bet their money market account is maybe paying 1% or something. So they're probably trying to get people to deploy their cash into their products.
I bet it's a little bit higher than that. But
You think
still,
so?
yeah.
Okay, maybe 2?
Yeah.
All right, well, whatever it is.
Either way.
You know, we don't use money market funds for our clients, not because we don't like earning them interest. What we typically aim to do is if they're retired, we like to keep around 2 to 3 months in cash. And to move that back and forth between a money market fund, you're really splitting hairs. So we really don't see the value add in doing that to our clients. So no, we don't really use money market funds. Doesn't necessarily mean they're a bad thing. But as far as an investment or an asset class to invest in, we typically don't like cash. I know cash was one of the best performers in 2018, but that's a big time outlier in our opinion. And if you did put a significant portion of your assets for an investment in a money market fund, you got to look at what that's going to do to your new target rate of return. Bonds typically average 3, 4, 5%. Stocks average 7, 8, 9%. Money markets probably average 0, 1, 2%. So I don't know why you would allocate 10% of your account or 20% of your account to a money market fund when you're going to be foregoing return. So what we do is we like to stay nimble. So we will keep 2 or 3 months in cash, not earning very much at all, with the expectation that that is going to be sent out to our clients. If you're still working, we'll keep that cash a little tighter typically, right? I mean, I know you help with this, with the allocation of this. It's usually around 1%,
typically,
right? Somewhere around there of the account, so very small in cash. But again, it's something that I have a stance against money market funds. I just think they're a low yield investment vehicle, and I don't see a place for them in the portfolio as far as an investment. What do you think?
Well, the one thing I would add to that is I've looked a little bit at, I've looked at a handful of money market funds because people have asked me this question before. And I would say that when it's been asked of me, it's less of where does it belong in the portfolio and more of, hey, if I have short-term cash like in my bank account, is there a better place where it could be earning more interest, right? So, and the answer, to that typically is yes. But again, I
would still use a certificate of deposit or a treasury note.
That's exactly what I was going to say. Yeah. If you go look at, your short-term money market funds versus a 3-month treasury bond from the U.S. government, I can't imagine there's going to be. The fact of the matter is, the treasury bond is probably going to be more cost-effective because it's not going to have any expenses associated with it,
right,
or very little expenses associated with it, where a fund might actually have an internal cost. And then secondly, it's very liquid too. And I suppose a money market fund is either. But again, if it were me, that's the way I would go as opposed to using a money market fund.
But so companies like Vanguard, don't they typically take the investors' money and probably go buy treasuries?
Yeah.
Right? So again, it's a whole deal. So that's why we don't use products.
And then they charge a small fee.
Yeah, then they charge a small. It's probably small, but they do charge a fee. But it's like, why don't you just go buy the treasury note directly?
Yes.
And that's what we do for our clients. So again, we don't believe in money market products because again, you're creating an unnecessary middleman that just wants to collect a fee. Now, if you're doing it on your own, I kind of get that.
Yeah.
So I could get that for the do-it-yourselfer, but for our clients, they're not hiring us to put them in products. They can go do that on their own.
Correct.
Our clients are intelligent. They understand what we're doing and they understand the services and the value that we bring to the table. They don't want us to just slap them in products because again, we're just watering down the fee. We're watering down the account with fees, and there's no reason to do that.
Correct.
All right, good. And then to our global topic, I just by the time this goes out to our clients, we'll be a little bit removed from it. But as of the day we're recording this, Tiger Woods just won the Masters. That's his 15th major championship. Did you watch it?
I watched on Sunday.
Okay, what'd you think?
It was, admittedly, I didn't plan on watching too much of it. But I got excited and tuned in on Sunday once I knew that, really
so
the main
watch
reason
the last hole?
No, I watched more than that, but not a whole lot more than that. My brother was visiting this weekend though, and he's
a golfer, right?
Yeah, he was tracking it much more closely, and wanted to be up watching all first thing each and every day. But it was fun to watch. I mean, it was exciting to see. I think a lot of people didn't think that. I mean, you're more of a golfer than I am, obviously. I think a lot of people thought that Tiger Woods might not ever win a major again.
Well, it's pretty interesting. During this week, he just received the Ben Hogan Award, which is, I believe, for the Comeback Player of the Year for last year.
Interesting.
And then he goes and wins the Masters. I mean, so they should probably give it to him twice. I mean, I got a little choked up, frankly, seeing him hug his kids and his mom.
It was a neat moment.
And all the players there to congratulate him as he walked in to sign a scorecard. pretty phenomenal. I mean, I saw an interview with Nota Begay. That's one of his best friends. I think he played college golf with him.
Right.
And he said that, I don't know, 2 or 3 years ago, he couldn't even hardly get out of a chair to walk.
I know.
Nota had to drive him to go pick up his kids, and Tiger had to like lean the recliner and the seat back, and now he's winning major championships. I mean, it's pretty phenomenal what this guy's done, and he's in his 40s. So not only has he come back from a major injury to win again, he's not in his 20s. I mean, he's competing with these guys that are 10, 20 years younger than him, and he's still right there. Typically golfers, you know, in their 40s, every now and then one of them will pop up. But, I mean, it was a pretty dominant performance. I mean, he out-thought them. He outplayed them. I mean, there was a lot to be said about what just happened.
How old? I mean, you said he's in his 40s.
Yeah, I think he's probably, I don't know, 43, something like that, if I had to guess. Somewhere around there, 42 maybe, I don't know.
What really, I don't know, puts that in perspective, I just hadn't really thought that much about, is crazy, is the fact that this was his 15th major. And
he's 41 anyways, I don't know.
Either way, he won the first 14 when he was like...
Yeah, it's been a long time.
He was, well, for one, like in 2005, or 2004, someone would have told you that Tiger Woods won't win another major until 2019. Right. You wouldn't have understood why.
Yeah, nobody would have believed that.
But it also puts in perspective how good he was.
Right.
Right, and how quickly he accrued that many championships.
So I think it's an excellent time for golf because you have this younger generation who grew up watching Tiger play.
Right.
And now they're getting to see it again. And now what's really exciting to me are guys like Brooks Koepka, you know, Justin Thomas, Jordan Spieth, all these guys who were little kids probably when Jordan was out there dominating.
Tiger.
Tiger was dominating. And I'm sorry, thinking of Michael Jordan. But when Tiger was dominating, and now I'm really excited to see them compete with them. And what was pretty cool is it didn't look like anybody was backing down. I think back in Tiger's heyday, a lot of people quivered. They just couldn't handle his bravado and you know, his alpha male. You know, I don't think they were intimidated as much as they just didn't. They just couldn't compete at his level. I really think though that that it's going to be fun to watch them not be intimidated by his play and see what that looks like. Whereas before, I felt like in years past, the guys just were frankly intimidated by him.
Like they knew if it came down to Sunday and they were in the
final they kind of folded.
He was going to win.
It wasn't even a deal. Well, now I want to see Brooks Koepka and Tiger and Dustin Johnson go at it.
So you think it'll raise the level of competition?
Yeah, I think because I think those guys are confident in what they do. I think they're amazing athletes. I think I think their mental game is. I really admire Brooks because that guy is so even keel out there, and even Dustin Johnson. They don't look like they get frazzled. They're just out there playing their game. So I want to see how that matches up against Tiger Woods.
What's the next major?
It's pretty cool. They redid their schedule, so I think they're going to happen like every month here, pretty back-to-back. So I think the next one is typically around Father's Day. I think it's the U.S. Open. No, that'd be in June. So there's got to be one.
Didn't they move the U.S. Championship?
The PGA. I think the PGA then is next.
That's the next one?
I think that's what they moved. So I think it's...
because it usually was the last one.
Yeah, so I think it's going to go the Masters, the PGA must be in May.
Okay.
And then the U.S. Open, which will be interesting to see because that's at Pebble Beach where Tiger's had a lot of success.
Oh, it is?
Yep. And then the Open, which is formerly the British Open, I think that's always in July. So I think it's going to be a great time for golf. So every month we're going to have a new story, and hopefully Tiger's in the hunt. I mean, we know he can win.
Yep.
Which is pretty remarkable stuff. So again, whether you like the guy or not, it's a pretty inspirational story. To say
I agree.
I mean,
that's fun to watch.
I mean, this weekend's going to go down in history forever. I mean,
agree.
That's going to be one of the all-time best Masters. So pretty cool,
or
pretty special
sports
weekend.
moments. Period.
Yeah. For me, definitely, but I don't know how the non-golfing world sees it. But for me, that was pretty amazing stuff.
I was following along on my phone on Twitter, and I feel like everybody and their mother and brother was all watching.
Yeah. Yeah, it's awesome.
Whether or not they were fans of golf.
Yeah, that's pretty cool stuff. So anyway, so that's all the time that we have for today's show. Thank you again, as always, for tuning in. Please subscribe to our YouTube channel and share it with your friends. You can also find us on all the various social media platforms. We're on Instagram, Facebook, Twitter, and LinkedIn. And you can find me personally on Twitter at Jake Falcon CRPC.
And you can find me at Corey Bittner KC.
Thanks again, and we hope you all have a great week.